So last week we finished up the first section and took the test, and I did kind of leave you hanging with some of the formulas that we did at the end of that section, and I told you that we would be using those in the upcoming chapters, and you will see how these formulas make sense. So now's the time for us to actually get our use out of those formulas that we had. And hopefully it'll start pulling all together here for you. Our section that's coming up, the next 4 chapters are all tied together. The chapter we're doing today is kind of an overview chapter. We're going to be looking at market structures. There are 4 market structures, and we will be studying each one of those. Again, today is sort of an overview chapter that introduces you to all 4 market structures, and that's going to be followed up by a chapter on each one of the structures. Let's see, perfect competition will be next week. The following week is monopoly, and then there's one chapter that has the last 2 combined. That's monopolistic competition and oligopoly. So you're going to see that the chapters do kind of flow together. Pass this back, please. Okay, so the whole section involves something called profit maximization. We're going to look at, remember in microeconomics, we're looking at how individual firms make decisions. So we're going to look at how firms determine where they want to produce, how much they want to produce, what kind of structures they're operating under will have a lot to do with that, and how they're going to maximize their profits, which is really the whole name of the game for firms, is they're trying to maximize their profits. We're going to use the marginal cost numbers that we came up with in the prior chapter. We'll also include marginal revenue as a calculation, and we'll be comparing those throughout the chapter. So your learning objectives are listed for you too. We're also going to talk about a couple of different kinds of profit: accounting profit and economic profit. Economic profit is going to be slightly different from accounting profit, which you might be used to if you have had an accounting class, or if you've just seen a typical presentation of the profit statements of different companies. So we'll look at that. And we will look at a rule that we're going to use throughout these chapters. That's the MR equals MC rule. It's going to go for every type of market structure that we have. So I'm going to start off by showing you a video that kind of leads into what the market structures are all about, so that you can see what we're headed for. Of course, your to-do list is there for the week, and you do have homework that's due. So let me get past the PowerPoints. We'll get back to those in just a minute. Let's take a look at the first video here. Oh, don't forget that this is the chapter where there was a page in your textbook, page 180, that had some problems with it, and I gave you some substitutions of that. So let's see which one I want to look at. Let's try this examples of market structure. Yeah, this can give you an idea of what we're going to be leading up to in this chapter.
We've given some thought to consumer demand, how consumers behave. We've given some thought to suppliers' costs of production. So we're now in a position to begin to examine how market prices are set. And we'll see But the way in which market prices are determined is dependent upon the market structure within which firms operate. We wouldn't expect prices in an agricultural market where there are large numbers of small firms to set prices in the same way that prices are set in an industry where there are just, say, a few very large firms. We'll look at 4 market structures. The first market structure, a very important one, is perfect competition. This is a market structure where there are large numbers of firms, all of them small relative to the size of the total market. And it's a market where it's relatively easy for new firms to join or leave the industry. At least it is in the long run. Remember, in the short run, the level of capital can't get into it. And perfect competition is a market where all firms produce the same product. It's a homogeneous product. It's undifferentiated. When economists are looking around for examples of perfect competition, they often choose agriculture. It's not that we've got to understand why. Perfect competition requires large numbers of producers. And in many countries, that's exactly what you get in the farming community. But it also requires an identical product. One farmer's onions is very much like another farmer's onions. So as a result, you've got a situation in which you've got a large number of producers producing an identical product, and therefore no individual producer, no individual farmer has control over the market price. The price is set by the interaction of supply and demand. Actually, what we find is that in some societies, agriculture is becoming less and less a good example because units are getting bigger and bigger, and agribusiness dominates the market. But here in Poland, we've got a very good example of perfect competition because we have large numbers of still very small producers. And we're going to see shortly that one of the implications of this kind of market is that the firm has no control over price. I'm interested in how the prices get set. Who decides how much they get paid?
It's not the settled price. Some of the price basically tells the price.
Does it vary very much?
And they say from week to week there are really huge actually differences in the prices.
Do you know why these prices vary so much from week to week?
Right now there's quite alright price because it's 450 per kilogram. The raw price is like 350 when it's really, really low. So the difference is quite big. It's from 350 to right now it's 450.
That's a big difference. Prices are determined by supply and demand. The producer has to accept the price that the market gives and simply make a decision about how much output to produce. Then we'll be looking at a market structure that we call monopolistic competition. Monopolistic competition is the kind of market structure where you have a fairly large number of firms producing a somewhat differentiated product, therefore different prices, and also relatively easy entry and exit into and from the industry. The high street provides some good examples of this kind of market structure. Bakers, chemists, etc., where there's a large number of stores all selling pretty much the same commodity, but where they try to differentiate the product in order to retain some control over price. The key difference is in the nature of the product. We're going to have a number of firms, freedom of entry into the industry being easy, but it's a market where each firm is able to make its product a little bit different from others. So we might think about restaurants. There are many restaurants in town. They all sell pretty much the same thing, food, but the decor is different, The chef is different. The menu is different. So each firm can differentiate its product, even though it operates in a market where there are many firms and it's easy for new entries to come in. That means that the firm will have some control over its price. If you're in a restaurant and you raise your price a bit, you're going to lose some of your customers. But some people will particularly like your restaurant, particularly like the decor, particularly like the food, and so demand for your product won't disappear entirely. But you will tend to have a relatively elastic demand. Having thought about that kind of market structure, we'll then look at a very different market, that which we call oligopoly. Oligopoly is a market which will be dominated by just a few large producers. And in these markets, entry into the market is restricted in various ways. It's difficult for new firms to join the market. Generally speaking, the product will be differentiated in some way. There are many markets of which you can think here. Cars, a few large producers selling a differentiated product, but it's difficult for new car firms to enter the market. Petroleum, banks, pharmaceuticals, airlines, many examples of oligopoly. These firms will face a downward sloping demand curve with a relatively inelastic demand in many cases, because the nature of the product can be really quite differentiated. A Rolls-Royce car is very different from a Ford. And finally, we'll look at the fourth and last structure that we're going to be interested in, monopoly. Monopoly is where there is just one firm, mono, Greek, one. Usually in this kind of market, there are very high barriers to the entry of new firms. It's very difficult for another firm to be able to compete with the existing monopolist. So, of course, the nature of the product is unique. Now, there aren't many markets where there is no competition, but there's an element of monopoly in lots of industries. For example, the Öresund Bridge between Denmark and Sweden is a monopoly. If you want to drive your car, you'll have to pay the monopolist for the privilege. Some train companies have monopolies. Local water utilities are monopolies. There are no close substitutes for water. Some electricity utilities are monopolies. And this means that the firm faces a downward sloping demand curve, often relatively inelastic. The monopolist has considerable control over the price.
Okay, so that's going to give you a touch of what we're going to be leading into. Again, we're going to talk about different market structures, and we will spend a chapter on each one of those four that were mentioned there, starting off with the perfect competition next week. So this one again is an overview chapter, and we're going to first talk about how firms decide how much of their goods they're actually going to produce. Let me see if I can get this to show here for you. Hopefully that's going to be recording for everybody there. This is, again, just the PowerPoint slide that you have copies of. So any firm, any for-profit firm's objective is going to be to maximize their profit, make as much profit as they can possibly do. Profit is just simply defined as total revenue minus the cost of the company. In economist terms, they look at cost being the cost of resources, which are land, labor, and capital. So revenue, again, minus cost. Revenue is simply the price of a good times the quantity sold, or P times Q. So you can kind of expand that profit calculation to say profit equals P times Q, that's revenue, minus the cost. And again, when you think in terms of an economist, you're talking about the cost of the resources, which are the land, the labor, and the capital. Now, last time we went through a chapter, we did compute marginal cost. Marginal, again, just means additional. So marginal cost was the additional cost of producing one more unit of a particular good. We're going to now add on the calculation of marginal revenue. Okay, again, the word marginal just means additional. So marginal revenue is just the additional revenue we would get from selling one more unit of product. And we're going to compare those two, the marginal revenue and the marginal cost. And we will find out that profit actually gets maximized at the point where those two are equal. Okay, and that's a rule we're going to use throughout these 4 chapters we're looking at. We're going to determine that firms, no matter what market structure they're in, will produce at the level where marginal revenue and marginal cost are equal. So that's that last statement down there, that supply rule, and the one right up above it. Profit is maximized at the output level where marginal revenue and marginal cost are equal. That's a very important rule that we're going to use throughout this particular section. Okay, so this just includes the formula for marginal revenue, which is very similar to the formula for marginal cost, except that we are looking at the change in total revenue divided by change in quantity for marginal revenue, whereas marginal cost, we looked at the change in total cost divided by change in quantity. So the marginal cost formula is the one that you had in the prior chapter. Marginal revenue is added in as a new formula for this particular chapter, but it's not too different from the marginal cost calculations. We're going to compare that MR and MC that we calculate, and the place where they're equal will be where the firm will maximize its profit. Now, this is the table that has things incorrect on it as far as what was in your book, and I have given you copies of that. If you misplaced it, it's also on Canvas. You can print it out again. But I'm going to flip over to the one that I printed out so we can walk through it and see what's going on, because there are errors on this particular slide. So if you want to cross out this particular slide and make a little note that we substituted with that page that I gave you, then that would probably be the best thing to do. Let me put this down and get my little hover cam up so that we can see the actual correct slide there. Okay, let's do it upside down. Okay, so this is the page that I gave you that you want to replace in your textbook as well as on your PowerPoint slides, or else you'll get very confused. Okay, and we're going to just walk through this because it does illustrate that. Let me see, my screen sharing is paused. Let's resume that. All right, get back up here. This is going to illustrate the calculation of the MR, which is new for this chapter, as well as MC, but shows you why that rule actually works for us. So you might recognize it being very similar to some of the charts that we looked at in the last chapter, where we see the quantity or the total output starting off at 0 and going up all the way to 9. Column 2, the price would be given to you, and you can see just some examples that they gave you in the textbook. When they're not producing anything, the price is $1,900. When they're producing 1, the price of that 1 is $1,700. At 2, the price of the good is $1,650, and so on down the list there. Okay, so column 1 and column 2 would be given to you. Column 3, total revenue, you now know that you can calculate column 3. Who remembers how you would get total revenue? Told you just a few minutes ago. How do you get total revenue? If all you had were these, all you had was column 1 and column 2, how would you get column 3? Does column 3 look like any division is going on with column 1 and column 2? How do you get column 3? How do you get total revenue? Y'all look at this. I'm not going to give you the answer. You're going to have to figure it out. This is easy. Just think, if a company is selling a good for $10 and it sells 10 goods, what would the revenue be? Sold 10 goods for $10, what would their revenue be? Just use your common sense. A company sold 10 goods. Each good sold for $10. How much revenue are they bringing in? Come on, guys. I know you got some common sense. You'll make me call on people? I sold 10 goods and each good cost $10. How much money am I making there? $100, right? 10 times 10. So you multiply, right? Column 3, total revenue is your price times your quantity. Why was that difficult? Help me out. Help me understand why you could not understand that you would take the price times the quantity to see what your revenue is. Is that something difficult? If that drink machine out there is selling drinks for $1.50 a piece, and it sells 10 drinks, then what kind of revenue do they have? $1.50 times 10 is what? $15. All right, you just multiply the price times the quantity. That's all. That shouldn't be difficult. Okay. Now, that one, of course, you could that third column you can calculate by just simply multiplying the first column times the second column. Okay, if you don't sell any, of course, you're not making any profit. or any revenue, excuse me, any revenue at all. You sell one and they're selling for $1,700 each, then your total revenue is $1,700. If you sell two and they're selling for $1,650, then your total revenue is 2 times $1,650, which is $3,300. If you sell three times selling price of $1,600 would give you a total revenue of $4,800, and so on. All right. So if you've got the quantity and the price, you can just simply multiply them to get your total revenue. Now, in this case, you would be given column 4, okay, the total cost. And to figure out your profit, again, it's just total revenue minus total cost. So in this case, I'm looking at what I came up with in column 3 minus column 4. 0 minus 1,000 is negative 1,000. What does that mean? What does it mean when I have a profit that's negative? You're losing money, right? You have a net loss. All right. 1,700 minus 2,000, still giving me a negative number. So the company's still losing money if they produce 1. Okay? They produce 2, the revenue is 3,300 and the cost is 2,800. So finally, they're making money. They're making $500 in profit. Okay? And we go on down the list here, looking at what their profit would be with the different levels of output. You will see that the highest that number gets is 3,800. Okay, 3,800 is where profit has been maximized, where it's at its highest. So I look back over and I see that this firm's maximum profit is going to occur when it produces 8 of these goods. That's why that particular line is kind of highlighted or shaded for you there. Now, another way you can find the maximum profit level is to compute MR and MC, marginal revenue and marginal cost. Those are the new formulas there. Marginal revenue is the change in your total revenue divided by the change in your quantity. Okay, notice there's nothing in the first line because I'm not changing from anything to 0. The first time I get a number is when I change from 0 to 1. Okay, so when I go from 0 to 1, my total revenue goes from 0 to 1,700. 0 to 1,700 is a change of 1,700 divided by the change in the output, which is 1. From 0 to 1 is 1, so 1,700 divided by 1 is 1,700. Then I would go from an output of 1 to an output of 2 and look at my total revenue. My total revenue is going from 1,700 to 3,300. That's a change of 1,600. 1,600 divided by a change of 1 is 1,600. Then I go from 2 to 3. Okay, from 2 to 3, my total revenue goes from 3,300 to 4,800. That's a change of $1,500 divided by a change of 1 again. And you would just calculate marginal revenue all the way down the list here. That's the additional revenue that the firm is bringing in as it produces each additional product. Marginal cost is the formula that you had in the last chapter. This is a change in the total cost divided by quantity. Okay, so we would be looking at column 4, the total cost column. Okay, again, there would be nothing before 0, so you'd have nothing in that first line there, but then I would go from 1,000 to 2,000, which is a change of 1,000. Again, divided by the change of 1 here, so I have 1,000. Then I would be going from 2,000 to 2,800, which would be a change of 800 divided by a change of 1, and so on down the list. The place where these two are equal, MR equals MC, profit is maximized. Okay, I go down the list, just run it down here, and the place where those two are equal is right there, 1,000 and 1,000. And I look back over here, and that is 8 units. Now, again, just use your common sense. Think about the word marginal. Marginal just means additional. Let's look at this when they produce one good. When their output is 1, they're bringing in additional revenue of 1,700, but it's costing them an additional 1,000. So should they produce it? Sure, revenues are good stuff. The revenues are outweighing the cost. When they go to 2, okay, the additional revenue is 1,600. It only costs them an additional 800. So should they produce 2? Yeah. How about 3? The additional revenue is 1,500. The additional cost is 700. So there's still the good stuff. The revenue is outweighing the bad stuff, the cost. All the way down, you'll see that the marginal revenue is bigger than the marginal cost. Here they're exactly equal, but let's look at what happens with the unit number 9. At unit number 9, the marginal revenue is 900. The marginal cost is 2,000. Would you produce the 9th one? No, because the bad stuff is outweighing the good stuff. Okay, the optimum place is actually where those two are equal. Okay, where they are equal. And that's where we get our profit maximization rule from. It's the place where MR equals MC. Well, suppose you had a chart where they were not exactly equal. Okay, you would produce up to the last point where the MR is greater than the MC. Okay, you would never go to the point where the MR is less than MC. Okay, so let me get back to my PowerPoints. Pull those back up. Okay, so again, that chart right there, you need to put a big X on it to make sure you remember, because there were definitely some mistakes on this chart. First of all, there's like crazy numbers here that don't even make sense right there. And then there were some numbers that, again, you could just tell didn't make sense to what's going on here. So they had some boo-boos on that chart. So make sure you are not trying to use that one. Okay, this is just a graphic display of all the things that were on that chart. Okay, we see our marginal cost curve there. We see our marginal revenue curve right here. when two things are equal on graphs, that just means they intersect each other. And if I look here where these two are coming together and drop down, I see that the maximum profit is at the 8 unit, where those two are equal. Marginal revenue to marginal profit. We've got a couple of other things drawn on there. The demand curve, they've got the average total cost curve. They'll come into play as we get going here, but I just want you to see that graphically where those two, the MR and the MC cross, that's where our profits would be maximized. All right, so that's just some basic rules about how we determine profit maximization. But we're going to find out that firms operate in different market structures. It's not going to change the rule MR equals MC. We're going to still use that, but it will change on how some of the total cost and how the revenue numbers are calculated. We'll see the differences as we go through some of those chapters. But the environment that a firm produces in and sells its product in is called a market structure. What we just saw on the video were illustrations of companies that worked in different market structures. We define the market structures by characteristics. Typically, we look at the number of firms in a market, how easy or difficult it is for new firms to go into the market or for firms that are existing to get out of the market. That's ease of entry and exit. And then we will also look at the degree that the products are differentiated. You remember him showing the onions. One onion was almost identical to another onion. The customer does not perceive those as being different products. But he went into the restaurants, and the food at one restaurant was perceived to be different than the food at another restaurant. They're both items of food being sold, but the products were very different. That McDonald's looked like a quarter pounder he was eating. No, it looked like a Big Mac, what it did. It looked like a Big Mac. Very different than the fancy restaurant where you were getting some kind of meal at a sit-down table with a white tablecloth on it. So this little chart introduces you to the 4 market structures down the left column there: perfect competition, monopoly, monopolistic competition, and oligopoly. And it gives you the characteristics that go with each of those market structures. Perfect competition, like the farming industry, agriculture, the onion farmer or whatever, there are very large numbers of firms in that particular type of business. Very easy to get into that kind of business. If you want to raise onions and sell them, nobody's going to stop you. Okay? And the product is considered to be standardized, meaning that it's the same from producer to producer. Perfect competition is like the ultimate market where everybody is on an equal basis. Okay? And it's total demand and supply that determines the price. But perfectly competitive firms still have to figure out what the best quantity to produce is, because they're still going to want to maximize their profit. Now, at the total other end of the spectrum is the monopoly type firm, like the electric company. I think you saw that in the video, or the trains or something like that. One firm is all there is. If you want that good, you have to go to that one firm. If I want electricity in my area, I have to go to Dominion Virginia Power. Okay, it might be a different firm in your area, but really don't have a choice. If you want electricity, I have one right there in my local area. No entry possible. Okay, there's lots of rules and regulations out there that will prevent other companies from getting into that business. And there's only one product, so you really don't talk about the product types in monopoly firms. Monopolistic competition. You're going to see that it has some characteristics of both perfect competition and the monopoly structure. First of all, there are a large number of firms in monopolistic competition. And I believe, like the restaurants, the food industry was the illustration that he gave. Lots and lots of people there. Very easy to enter. Okay, so again, very similar to the perfect competition. The difference from perfect competition is in that product type, that last category there. The products are seen to be differentiated, or they are different, okay? In the consumer's eye, they actually, there's something different from one to the other, like the restaurants. I always give an example of soft drink companies as also being examples of monopolistic competition. There's lots of soft drink companies out there. It's pretty easy if you want to make soft drinks to get into that business. But in the consumer's mind, there's a difference between a Pepsi and a Coke. Okay? There's some kind of perceived difference there. Then the oligopoly. Again, the oligopoly is going to have some characteristics similar to perfect competition and monopolies. This time it's a little bit closer to the monopoly side. Few firms, not a large number like the perfect competition or the monopolistic competition. Just few firms, not all the way down to one though. Entry is impeded, meaning there's something that keeps firms from getting into that type of business. It's not impossible like it is with a monopoly, but it's very, very difficult to get into that business. Products can be either standardized or differentiated. I think he gave the auto industry as an example. I always think of airline firms as an example of oligopolies. There are a few airline companies out there, but it's not impossible. If you wanted to start an airline, you could do that. Okay, and you know, it's still more than one out there. All right. So now the way that that I like to perceive this, share again to my little hover screen. To me, it's easy to see if I draw like a little spectrum here. And on one side, I put perfect competition. And on the other side, the almost exact opposite is the monopoly. They are almost opposites. In between these two are the other two types of market structures. Monopolistic competition has characteristics of both perfect competition and monopoly, but it's a little closer to the perfect competition side. And then the oligopolies, again, has characteristics of both perfect competition and monopoly, but it's closer to the monopoly side. So again, we're going to be looking at each one of these in more detail. This chapter 10 is perfect competition. We do that next week. Chapter 11 is monopoly. We do that the following week. And then the last two are combined into chapter 12. So that's how we're going to do the next set of chapters as we go through this section here. So some of the material you'll see repeated, like some of these characteristics. It'll be repeated in each chapter, but then you're going to get into more detail about each type as we go on. That make a little sense with the spectrum there, how some of them are a little closer to one way or the other. All right. Back to my PowerPoint. All right, so again, that's a nice little chart right there just to use as a little study tool to make sure you understand the characteristics of each type. The next few slides just kind of walk you through those characteristics. So I have touched on most of these things there. Again, perfect competition has many large firms. No one firm has the ability to affect the market, like those hog sellers. I guess they were hogs, pigs, hogs, whatever. They couldn't really try to set the price on those hogs. They had to just take whatever the market was at the time. It's demand and supply that deals with that. Those firms are what we call price takers. You might want to underline that, price takers. They have to take whatever the market says the price is going to be. The products are identical, meaning the consumer could substitute one farmer's onions for another one. Very easy to enter into the industry. One little tad bit of information that's extra here is that the demand curve is horizontal. Okay, that's because you see here that horizontal demand curve, even a tiny change, even a penny change is going to make customers go and switch from one firm to another. If I can buy onions from one firm a penny cheaper than I can for another, I'm going to go with the cheap one, because in my mind there is no difference from the onions from one farmer to the next. Okay, so you have a perfectly flat horizontal curve, perfectly elastic, if you can remember that from your chapter on elasticity, meaning it responds immediately to any change. Okay, the other end, the monopoly, again, is where there's just one firm. Whatever that firm is producing, there are no close substitutes. Okay, entry is not possible by other firms. Now, this type of firm is called a price maker, totally opposite from the perfectly competitive firms. These are price makers. They're the ones that get to set their own price. They're the only ones offering the goods, so they have the ability to set their own price, to make their price. Okay, but they do still have to consider what quantity they need to produce, because they're still going to want to maximize their profits. Just because they can set the price doesn't mean they're just going to charge extraordinary prices, because people will finally just stop buying the good. Okay? At some point, they will not buy as much as it would be to make the company profitable. The demand curve for a monopoly firm, since it's the only firm in the market, then the market curve is the same as the firm's curve. It is downward sloping, just a typical downward sloping curve, which again is just saying that in order to sell more, then the price has to be reduced. Monopolistic competition, one of those categories that has characteristics from both ends. Okay, large number of firms, easy entry. The thing that you have to remember that makes the monopolistic competition different is that the products are considered to be differentiated. So what happens is each firm really has its own little mini market. Okay, yes, it's true that I can substitute a Pepsi for a Coke, but if I want a Pepsi, I have to go to Pepsi. Okay, if I want a Coke, I have to go to Coke. So there are substitutes, but they're not identical substitutes. All right, so these firms are also price makers because they are the only ones sort of producing their own little mini monopoly. The demand curve is downward sloping, depending on how differentiated the products are, whether it's a steep downward sloping or a more flat one, just depends on the company. All right, and then the oligopoly, close to the monopoly side. Just a few firms, certainly more than one than the monopoly type firm has, but they are few enough so that each firm can affect the market. Entry is more difficult, but it can possibly occur. Okay, so the airline industry is, again, an example here of an oligopoly. Here's a new term right here that we'll explore more when we look at the chapter specifically on oligopoly, is that the firms are interdependent. Now notice that word is interdependent, not independent. Okay, they're interdependent, meaning every firm is affected by what the other firms do. And if you've ever watched the airline industry, you know that if one airline offers tickets on sale, then the others will follow. Okay, they kind of watch what each other does. The demand curve is also downward sloping, but the shape depends on how the competition is behaving. Okay. So again, a nice little chart that includes a few extra things called behaviors for each of the 4 market structures. There's also a column here that we really haven't talked about. We talked about the strategies, whether they're price makers or takers, and whether they're interdependent. But we really didn't talk about the promotion strategy that each type of market does. What kind of marketing do they do? Well, think about the perfect competition like agriculture. I don't think I've ever seen an ad that an onion farmer ran. Okay, they don't do any kind of marketing at all. Okay, if they do, like the milk industry, I see, got milk, I see some ads with that. That's usually kind of a public relations kind of thing.
So I guess most of the industries in the United States are oligopolies.
I would say most of them are monopolistic competition. Okay, where there's many firms, but there's just something different from of the products involved. Monopolies, I don't see monopolies doing much promotion either, other than if it's just a goodwill kind of thing. The one that does a lot of promotion are the monopolistically competitive firms. Why? Because they're trying to show you why their product is different from the other product. See lots of Coke and Pepsi ads, right? And they're trying to convince you that one's better than the other. One of them's going to give you more energy. One of them's going to get you the pretty girl. One of them's going to make you smile more, or whatever. They're not usually talking about the cost, though. I've never seen an ad that said Pepsi cost 25 cents less than Coke does. They're not dealing with the price at all. They're just trying to show you what their product does that's different than the other products, than their competition. And then the oligopolies, like the airlines, sometimes you'll see them do not much promotion at all, and then you'll turn around and you'll see them doing more than that as far as advertising. I can't think that I've really seen a lot of airlines advertising much lately. Airlines have had a pretty rough time with all the safety issues that they have, so I don't really see them doing advertising that's going on with that. So I think there's one more graph up here in this chapter there. That just shows you how the graphs would look if you were dealing with perfect competition versus if you were dealing with a firm that has a downward sloping demand curve. But you're still looking at the point where MR equals MC crossing as being your place to maximize your revenue. All right, let's take a break, come back, we'll watch a video, and then we'll talk about the difference between accounting and economic profit. So I've got 3:30, let's come back at 3:45, and we will pick up with a video there for us. Examples for each, so hopefully you were able to answer her question right off the bat there. And, we're pretty clear about the 4 different market structures and the characteristics that go along with each one of them. Again, we'll spend an entire chapter on each one of these so that hopefully you'll be well versed in these before this particular section is over with. All right, so we know there are different market structures. We know that there is a rule about profit maximization. What's the rule? What are we looking for when we want to maximize profits? Same rule applies to all 4 types. What is it? What did we look at the chart for? When we did the chart, what were we looking for to find where profits were maximized? Did y'all sleep through that? One rule. What was it? I'm going to sit here till somebody tells me what it is. What's the rule for profit maximization? Thank you. MR equals MC. Yeah, did y'all just bypass that? Nobody else knew it, but hey. And it was only one. So what do I need to do to get you all to understand, to remember things as we go through them in class? Because I'm clear I told you to highlight that on your sheet. Okay. You're going to have a tough time if you can't remember MR equals MC through these next chapters. It's the same rule in all of the chapters. We're going to look for the place where MR equals MC. Marginal revenue equals marginal cost. Y'all say that back to me. Say MR equals MC. And what happens when MR equals MC? Profit is what? Huh? Maximize. Say it loud. You can say it loud. You're right. Profit is maximized. That means it's at its highest point. Say MR equals MC is where profit is maximized. Okay. That was pretty weak. That was pretty weak. I don't know what the deal is here. All right. Well, because you all are having difficulty with that, I'm going to watch another video. On that one. We're going to watch her do the calculations. If you didn't like me doing them, let's see how Jody the econ girl can do.
At a basic level, the goal of every firm is to maximize profit. Granted, firms may have other tangential goals, but they probably still want to know how to maximize profit in order to analyze the trade-offs that they face between profit and other. As you recall, profit is just equal to total revenue minus total cost. Or in other words, the total amount of dollars that a firm is bringing in sales minus the total number of dollars and other opportunity costs that it's paying out. So profit is just what's left over. Now, when we talked about total revenue before, we noticed that revenue was both a function of price and quantity. And obviously those two things are interrelated in large part. But usually when we think about maximizing profit, for reasons that will become obvious later, we think about the firm as setting the quantity that maximizes the amount of profit that it gets. So all the decisions that we're dealing with here are going to be about choosing quantity rather than specifically choosing a price. The concept of profit maximization can be most easily introduced via an example. Suppose I gave you the following information regarding demand for a company's particular product and cost to produce the company's particular product. So what we see here is in order to sell 0 units, well, our price is sort of irrelevant in this case. If the firm wants to sell 1 unit of its product, it can set a price of $18 to still have one buyer for the product. If it wants to sell 2 units, it has to lower its price to $15. If it wants to sell 3 units, it has to lower its price to $12. If it wants to sell 4 units, it has to lower its price to $9. If it wants to sell 5 units, it has to lower its price to $6. And if it wants to sell 6 units, it has to lower its price to $3. This is just consistent with the concept of the downward sloping demand curve that we're assuming that this term here faces. On the cost side, if the firm wants to produce 0 units, it's costing them $4. In this case, the $4 just represents the fixed cost of being in that industry in the first place, since we said that fixed costs are present even if the firm isn't actually producing any output. But we can see that it costs in total 6 units, or $6 to produce 1 unit. It costs $10 to produce 2 units. It costs $16 to produce 3 units. It costs a total of $24 to produce 4 units. A total of $34 to produce 5 units. And a total of $46 to produce 6 units. So just given this information regarding quantities, prices, and costs, we can go ahead and figure out what quantity of production actually maximizes profit. So you notice here I have a column currently blank that's labeled total revenue. And we said that total revenue is just price times quantity. For example, if I sell 3 units of output at $6 a piece, I've made $18 in revenue. So we can just calculate this total revenue by multiplying quantity times price. And we get, well, 0 times anything is just 0. So if you're not producing anything, you're not taking in any revenue. Selling 1 unit at $18 gets you $18 in revenue. Selling 2 units at $15 each gets you $30 in revenue. Selling 3 units at $12 each gets you $36 in revenue. Selling 4 units at $9 each also gets you $36 in revenue. Selling 5 units at $6 each gets you $30 in revenue. And selling 6 units at $3 each gets you $18 in revenue. Now we said here that profit was just equal to total revenue minus total cost. And now we have total revenue and total cost. So we can go ahead and calculate the profit generated by each quantity of output here. So here, 0 minus 4, which is negative 4. 18 minus 6 is 12. 30 minus 10 is 20. 36 minus 16, also 20. 36 minus 24 is in fact 12. 30 minus 34 is negative 4. And 18 minus 46 is, if I'm not mistaken, negative 28. Now what we see here is that we get increases in profit for a while, and then as we increase our quantity further, we're actually decreasing our profit and even getting into negative profit territory here. Negative profits are certainly possible if the cost of producing output is less than the revenue you took in from selling that output. And what we see here, if we're looking for the biggest numbers in our profit column, well, those happen to be these 20s here. And if we're just looking for what quantities maximize profit, well, it seems like based on our example here, that either setting a quantity of 2 units or 3 units is going to result in the largest possible profit. So one way that we can maximize profit is to just enumerate all the different possibilities and then pick the biggest profit. But there's actually a mathematically more reasonable way. To think about how to maximize profit, we could also think in terms of marginal revenue and marginal costs rather than total revenue and total cost. Just for review, marginal revenue is just the additional revenue we get per extra unit of output, or you can think of that as change in total revenue divided by change in quantity. Similarly, marginal cost is just the additional total cost we incur for each additional unit of output. And we can think of that as the change in total cost divided by the change in quantity. We can go through here and we can calculate at each change in quantity, whether it be going from 0 to 1, 1 to 2, 2 to 3, 3 to 4, and so on and so forth. We can calculate marginal revenue and marginal cost. So for example, on the marginal revenue side, if when we go from a quantity of 0 to a quantity of 1, our revenue goes from 0 to 18, then our change in total revenue divided by change in quantity is just 18 divided by 1, or 18. When I go from 1 unit to 2 units, my total revenue goes from 18 to 30. So again, my change in total revenue divided by change in quantity is just 30 minus 18, which is 12, divided by 2 minus 1, which is 1, or just 12. When I go from 2 units to 3 units, my change in total revenue, I go from 30 to 36. So I get a change of $6 for a 1 unit change in output. So in this case, marginal revenue is going to be 6 over 1, or 6. When I go from 3 units to 4 units, my total revenue doesn't change. It goes from 36 to 36. So my change in total revenue divided by change in quantity is just 0. When I go from producing 4 units to 5 units, my total revenue actually decreases. It goes from 36 to 30 for a difference of negative 6 units, since I decreased by 6 units. So in this case, my change in total revenue is just negative 6 divided by 1, or negative 6. When I go from 5 units to 6 units, my total revenue goes from 30 to 18 for a loss of 12 units, in which case my change in total revenue divided by change in quantity is negative 12 divided by 1, or negative 12. You'll notice here that I put my marginal numbers sort of in between these two quantities, and some textbooks will do that, some textbooks won't. Sometimes we'll put this 18 in line with this first unit, since it's technically the marginal revenue associated with producing this first unit. They'll put the 12 with the 2, and so on and so forth. So sometimes you'll see these shifted down a little bit to correspond to these units. I put them in between the quantities just because it makes sense to some degree to say, well, if this is the marginal revenue and going from a production of 0 to a production of 1, we'll just sort of put that in between the 0 and the 1. And we'll see how to deal with that graphically in one after that. In a similar way, we can go through and calculate marginal cost for each quantity of output. So the marginal cost incurred in going from a production of 0 to a production of 1, well, our total cost just goes from 4 to 6 for an increase of 6 minus 4, or 2. And our change in quantity, well, we just went from 0 to 1, so it's a change of 1 minus 0, which is 1. So in this case, our marginal cost is just this increase of 2 divided by 1, which is 2. In going from 1 unit to 2 units, our total cost goes from 6 to 10, an increase of 4. And our change in quantity is just 1, so our marginal cost is 4 divided by 1, or 4. In going from quantity of 2 to quantity of 3, our total cost increases from 10 to 16. This is an increase of 6 for a quantity increase of 1. So our marginal cost is just 6 divided by 1, or 6. In going from 3 units to 4 units, our total cost increases from 16 to 24, which is an increase of 8. Again, for a 1 unit change in quantity, so our marginal cost is just 8 divided by 1, which is 8. In going from a quantity of 4 to a quantity of 5, our total cost increases from 24 to 34, which is an increase of 10 for a 1 unit quantity increase. So our marginal cost is just 10 divided by 1, which is 10. And going from 5 units to 6 units, our total cost goes from 34 to 46, which is an increase of 12 for a 1 unit quantity increase. So then our marginal cost is just 12 divided by 1, which is 12. What you'll see here is that the marginal revenue and the marginal cost that corresponds to this profit maximizing quantity, or this set of profit maximizing quantities, are those which marginal revenue and marginal cost are same. So notice It's right here. So we'll see our profit is maximized at that point where marginal revenue equals marginal cost. And this is going to be an important rule for us to understand. Because what you can see here is that in going from production of 0 units to 1 unit, we got 18 additional dollars in, but only 2 additional dollars out. Well, that means that producing this first unit added $16 to our profit. We say, well, yeah, we want to produce that unit. It brought in more money than it cost us. Cool. Then we ask ourselves if we want to produce the second unit. We say, well, the second unit brought in 12 extra dollars and only cost us 4 extra dollars. So it actually added $8 to our profit. Adding things to profit is good. Yeah, we want to produce the second unit. Now, when we get to this third unit here, we say, well, producing this third unit brought in $6 in revenue, but it also cost us $6 to make. Technically speaking, we're kind of indifferent as to whether or not we produce this third unit, but in most cases, we just say, sure, why not? We'll produce this unit as long as marginal revenue is at least as marginal cost. And then we get to this fourth unit here. We say, well, this fourth unit doesn't actually add anything to our revenue, but it costs us an extra $8 to make. Well, clearly, we're not going to want to make that unit. So we stop our production at a quantity of 3, which corresponds to this idea of profit maximization. But I know that this is a little bit confusing here that we have 2 quantities that technically both give maximum profit. But this problem actually goes away when we stop thinking about discrete units of production and think about continuous cost curves. In general, we can say that when marginal revenue is greater than marginal cost, that our profit is increasing as a function of quantity. And that's simply because if marginal revenue is greater than marginal cost, then producing an extra unit will bring in more dollars than we have to pay out. So our profit is going to be bigger as we produce more units. On the other hand, if marginal revenue is less than marginal cost, then our profit is decreasing as a function of quantity. And again, hopefully that makes sense because if marginal revenue is less than marginal cost, then by producing an extra unit, we're actually taking in less extra money than we're paying out extra. So well, that's not really worth it because that's actually going to serve to lower our profits. If we put these things together, we see intuitively that we hit our maximum profit when this condition of marginal revenue being equal to marginal cost holds. And this is just a generalization of the example that we just worked through. Because when we hit this condition of marginal revenue equaling marginal cost, then by producing that last unit, we took in exactly as many extra dollars as extra dollars we paid out. If we were to think about this idea of marginal revenue versus marginal cost graphically, we get something that looks like the following. And this is just because as we produce more units, our marginal revenue tends to be a decreasing function of quantity. And as we said earlier in our cost curves discussion, marginal cost tends to increase as quantity increases. So we would see something here where marginal revenue is, sometimes it's flat, but it's either flat or decreasing in quantity, and marginal cost is generally increasing in quantity. So what we would see here is if we were to think about, well, do we want to produce this first unit here? Well, my marginal revenue, the extra dollars from selling this unit are all the way up here. The marginal cost is all the way down here. So yeah, selling that first unit seems like a pretty good idea. If I were to ask myself, do I want to produce this next unit? Well, the marginal revenue of producing that next unit wasn't quite as high as that for producing the first one. The second unit was more expensive to produce than the last one, but nonetheless, producing this second unit is still adding something to profit. It's adding exactly this amount to our profit. As long as it's adding something to our profit, seems like a good idea. We could keep going with this line of reasoning. We could say that this unit here is still profitable to produce, this unit here is still profitable to produce, and so on and so forth. And we would eventually get to this point here, which is exactly our point where marginal revenue equals marginal cost. So we say, okay, we've produced all these units that are profitable to produce, and we're going to stop here because any additional units cost more to produce than to bring in revenue. So you can see here how we're making that decision. At each step, we're thinking on the margin, as rational people in firms do, in order to figure out at each stage whether we want to produce one more unit or one more unit. It's important to recognize that this Q star that I've labeled here, which turns out to be the profit maximizing quantity of output for this particular firm, it doesn't necessarily correspond to the quantity that gives the highest profit margin, the highest markup, or anything like that. In fact, we can see here that it was this first unit that has the highest profit margin or markup, since the difference between marginal revenue and marginal cost is biggest here. And that difference between marginal revenue and marginal cost keeps decreasing as we produce more output. Nonetheless, it makes sense to think about this as we want to produce all of the units that produce at least some positive or at least non-negative profit for the firm, because that's how we're actually going to get the maximum amount of profit. You know, if I were to say, for example, oh, do you want to produce one more unit of output? It only adds $1 to your profit, whereas the first unit you produce added $10 to your profit. We'd still say, well, $1 is more than 0, so I want to produce all of those units that actually add to my profit, which is exactly what we're showing. For those of you that are using calculus to maximize profit, you'll notice that we actually reach the same conclusion as we did before when we think about how to maximize profit using derivatives. So again, profit is just equal to total revenue minus total cost. And in calculus, we say if we...
Okay, definitely are not going to do calculus. So I'm going to stop her at that point. But that's basically what we went over with the chart that we did first thing, but since you all didn't seem to truly get what was going on there, I thought I would let you see her illustration of it. And hopefully between the two of us, you will understand that profit is maximized where? MR equals MC. Thank you. Thank you very much. You're still mighty quiet, but we'll let you go with that. All right. So let's get back and now talk a little bit about different types of measures of profit, because economists do things a little differently than accountants do. If you have had an accounting class or some kind of personal finance class, even a financial management class, you have typically calculated what's known as accounting profit. Accounting profit, again, is just your total revenues minus your total cost, just like you normally would think of it. Total revenue is the price times the quantity of the goods. Total cost would be the cost of all the things that go into making your company do its job. That means in economics terms, that's the cost of all the resources, the land, the labor, and the capital. So hopefully as a firm, you're looking for a positive number there. You want your total revenue to exceed your total cost. And that's typically what we think of when we're doing profit calculations. But economists look at things a little bit differently. They include something else in the cost. It's still total revenues minus total cost, but they're going to also remove what we call the cost of ownership or equity capital, which is essentially all the opportunity cost. It's what you could have gotten if you put your resources somewhere else, okay? So it's also known as opportunity cost or cost of equity capital. Now, economists really are looking for this zero economic profit. They want their total revenue minus total cost to be zero. If a firm ends up taking more away from its revenue, then we say that the firm has a negative economic profit. Of course, if it is returning more to its owners than their opportunity cost, then it has a positive economic profit. But what we're looking for is that zero economic profit. That's a firm that's not adding or subtracting anything of additional value. It's actually the revenue is sufficient to pay the cost, but it does not generate anything in excess of it. In other words, the firm's equity is all being placed exactly where it needs to be. Now, the reason we say that zero economic profit is what we're aiming for is because if a firm has a negative economic profit, that means that the firm's owners are not getting their full potential. They could actually go and invest somewhere else and make more money. That means firms will start leaving that business. So if you have a negative economic profit, firms will start getting out of business. On the other hand, if you have a positive economic profit, other firms will look at you and say, wow, I can make more money if I get into that business. So you'll end up with other firms coming into your business and taking away some of your profit. So what you're aiming for is the zero economic profit. Okay, that kind of sums what I just said there. When a firm earns a positive economic profit, then investors are actually earning better returns than they would normally with competing investments. So other investors will want to get into that business too, so they can earn more. That's a positive economic profit. All right, of course, the negative means people are going to start getting out of the business. So let's see if we can look at a video with this one to stop that share. This one explains the economic profit a little bit, because you do have a homework question that asks you to calculate accounting profit and economic profit. Mr. Clifford.
Hey, how you doing, econ students? This is Mr. Clifford. Welcome to ACDC Econ. Right now, we're going to talk about profit. No, not that kind of profit. As you know, the goal of every business is to maximize profit. And it turns out there's actually two different types of profit. There's accounting profit and economic profit. And before we go any further, you have to know that economists hate accountants, and accountants hate economists. No, I'm serious. If I'm walking down the street and I see an accountant, it is on. It's kind of like Peter Griffin and that chicken. The reason why they hate each other is because they both have a different way of calculating profit, and they both think that they are right, even though the accountants are clearly wrong. You probably know that profit is all of your revenue coming in minus all your costs. but what costs should be included? For example, every business has certain explicit costs. These are out-of-pocket costs that they would normally pay. For a restaurant, this would be the price of hiring the workers and paying your rent and all the other ovens and things that you need to run your business. Again, that's called explicit costs. When accountants calculate profit, they're looking at just explicit costs. They're looking at the total revenue minus the explicit out-of-pocket costs that you normally think of. But economists know better. We know that explicit costs are not the only type of costs. There's also opportunity costs. These are implicit costs. So when you run a business, you put your money into it, and you could be doing something else with your money, or you could be doing something else with your time. The value of those things are implicit costs. So economic profit is your total revenue minus your explicit and implicit costs. Now let me give you an example that will make more sense. Let's assume that LeBron James leaves the NBA to go open up a taco shop. So he opens up this taco shop and he gets a certain amount of revenue. Let's say $2 million of revenue coming in. Right? He also has certain explicit costs of running the business. You have to pay for cheese and meat for the workers and for rent, for the tables, and that comes up to about $1 million. The accountant would calculate his profit and say he's making $1 million. 2 million minus 1 million equals $1 million. So the accountant would say, hey, great job, well done, you're making a lot of money, congratulations. But the economist also factors in the implicit costs, the $20 million that he could be making if he stayed in the NBA. So let's calculate economic profit. It's the $2 million of revenue minus the $1 million of explicit costs. Also subtract out the $20 million of implicit costs. So if you look at it that way, LeBron's actually losing $19 million by opening up that taco shop. It's a loss, not a profit. Take that, accountants. Accountants are important to figure out how much your company earning and trying to pay your taxes. But economists are better at figuring out how much is your real profit when you're trying to make decisions. Going back to the taco shop example, what if I told you that next year LeBron made zero economic profit? Is that a good thing or a bad thing? Your first thought is that zero economic profit is a bad thing, but actually it's not. Think about it. To have zero economic profit, your total revenue has to equal your explicit and implicit costs. So LeBron could be making just as much money opening the taco shop as he would working in the NBA. So his total revenue must be huge, and his accounting profit has to be positive. So the idea of zero economic profit is called something. It's called a normal profit. In a competitive market, firms break even and make zero economic profit because they can't make more profit doing something else, or they would have gone and done that other thing. The flip side of that is if they are making a bunch of profit, other firms will jump in and that profit will go away. The point is, making no economic profit is a perfectly normal thing, and that's why it's called normal profit. All right, hopefully that makes sense. Until next time.
Okay, I think that's a pretty good example. You can understand the opportunity cost a little bit when he's explaining the LeBron James information, because we can all see that LeBron had opportunity cost. He has, if he were not running the taco shop, he could be playing NBA, right? So he has an opportunity cost. He has given up playing the NBA just to run his taco shop. That's a lot of money to him. All right, so his resources really could have been used somewhere else more efficiently. So I guess the fact that he says economists hate accountants must mean I hate myself, because I'm both an accountant and an economist. So that's kind of rough on me. I guess I'm internally fighting all the time. But I hope that that will help you explain your homework, because they give you one example and ask you to calculate both the accounting profit and the economic profit. Just remember, the accounting profit are the things that you normally think of for costs involved. Things like your labor and your materials and your machinery and all that kind of stuff. Things that cost that you can actually see and feel. But economists are also going to back out the implicit cost, which is the opportunity cost, sometimes called the cost of equity. So hopefully that will help you with that. Okay, so you do have homework due. Again, it's a little table for part of it, which will be calculating the profit maximizing information, and then you'll have a couple questions on accounting and economic profit. Okay. What kind of questions do you have? Anything? Stop the recording here.